David Nelson is chief strategist at Belpointe Asset Management. Thanks for being with us, David.
Thanks for having me.
All right, put a couple of points together for us here. We've got the U.S. 10-year yield around 4.77, let's call it. Some are saying it could get to 5. That could be quite a threshold, and you say that would really change the conversation. At the same time, you're saying the Fed doesn't really matter anymore at this point. So explain that for us.
Well, let me rephrase that. It matters only in the sense that that investors have already digested the fact that the Fed is not going to give us the number of rate cuts we had hoped. You know, it wasn't that long ago we were looking for 5, 6, 7 cuts over the next year and a half. And now, at best, maybe we're looking at 2. But the problem, as you just stated, is really more on the long end of the curve. It is a very different conversation when you start to get above 5%, because most valuation models start and end with the risk-free rate. And that's the hurdle rate. It doesn't mean that stocks can't do well if you choose them properly, but it makes the threshold that much higher. The earnings have to be that much better.
All right. Now, as far as earnings, they'll be kicking off this week. The big banks will do the honors there, as always. So what are we expecting from Q4 in general?
Right now, the consensus expectations are about, anywhere from 270 to 275 for the year for the S&P 500. And the good news is that those estimates have continued to rise. And that's, the glass is half full backdrop. The battle against, higher rates will probably largely spell out, what markets are going to do between now and the end of the year. The good news is, we're still in the early stages of a pretty important technology shift, and it goes beyond even the tech sector. It's going to affect, almost every company in the industrial complex, and I expect a productivity bump from that.
You're also saying, David, that 60-40 is not working. 60% stocks, 40% bonds. That's traditional, and one could argue that it really hasn't worked for a long time. So is that a real conundrum for investors and managers too?
It is. As much as I love stocks and I love talking about stocks, putting all your capital in a risk-on asset for most people is financial malpractice. We need something to offset that risk. And for the last couple of hundred years, fixed income was the diversifier. It has not worked, and it has not worked for a really long time. Just in September, you're probably down about 6-7% in the aggregate bond index. Over the last decade, you've made maybe a little over, on an annualized basis, 1% a year. That doesn't do it. It doesn't give you the income, and it doesn't give you the protection that investors demand. And clearly, we're going to have to start to think outside the bond box and start to come up with some alternatives.
All right. We have the incoming Trump administration, Inauguration Day, January 20th, of course. What are you expecting? It's difficult to know, I know, in terms of policies and so on. But what are the biggest risks to the economy as we usher in the new administration?
Whenever you have a new administration, there's a little bit of angst, because you're unsure of how these policies will roll out over the year, in particular with Trump and the fact that he is bringing on tariffs. I think of tariffs as really a negotiating tactic. You can argue on either side of it whether tariffs will be ultimately good for the economy, but it is a very important tool when you're dealing with countries that don't give you reciprocity. China was certainly, an egregious offender of that, so much so that the Biden administration even carried the tariffs forward and even added more. So some uncertainty about that. DOGE is uncertain. Because, one man's fraud and waste is another man's source of income. So you could see a turn down in government hiring over the next couple of years. That it could affect, the jobs market, and in turn affect what the Federal Reserve does.
All right. Well, clearly you've thought through some of the ramifications. Now, as far as technology, if, again, we see the 10-year, let's say, get to 5%, we know what happened in 22 when rates got high. Tech really sold off, and the markets did in general. Do you foresee anything like that for technology, which has had, of course, such a great run?
It certainly makes it a lot tougher, especially for, very high multiple stocks. NVIDIA is certainly an important stock. It does trade a higher multiple, but I would give it the benefit of the doubt in that its pay ratio is actually less than 1. So the growth has to be there to support the multiple. So just having growing at 10% with a PE multiple of, say, 30 or 40, that ain't going to cut it.
Let's get to a couple of names that you have for us here. One is in AI, although it's on the natural gas side, and I happen to own this one, Antero Resources. What do you like about this one? The data center needs, I guess, right?
It's certainly that. As a matter of fact, in data center, over the next 3 years, the annual energy use could reach 74 to 132 gigawatts. That's equal to close to 12% of total electricity consumption in the United States alone. So we know AI, we know a lot about AI, but the one thing we do know for sure is we're going to need power and a lot of it. And as much as I like the concept of nuclear, SMR, small modular reactors, and all this new technology, we need the power right now. And natural gas has to be the go-to energy. It's the cleanest of the fossil fuels. And Antero Resources is a leader in this. There's lots of them. I would put a basket together of these names, but these are free cash flow machines. In particular, this one, free cash flow yield of about 17%.
And then you don't often, or generally people don't tend to think about Hewlett-Packard Enterprises that much these days, but you say it's an AI play. Why?
This is an AI play that even a value investor can love. It's a way to buy into the AI data center and infrastructure build out at about 9-10 times forward earnings. As a matter of fact, they just got a very important contract on Friday from Elon Musk and XAI, $1 billion contract. That's a big contract for a company this size. They're in competition with Dell. It looks like they beat them out on this one. Also, they have proprietary technology in chip cooling, which we know is very, very important for the GPUs that NVIDIA manufactures. They partner with NVIDIA, so I expect this to be a real winner over the next year, especially if multiples are pressured.